Getting into options, you will probably first start with buying outright puts or calls. It's simple. You have only one leg to worry about, one option to close for profit or loss, only one whose path you have to project, and so on. But this is a trap. Everything that makes it so great is what makes it a problematic way to trade. That single option's payoff depends on so many factors that you have to have an opinion on before entering the trade. You have to be right on the direction, path, timing, magnitude, exit, and many more to have positive expectancy in such a trade. It gives you exposure to numerous factors, and this is also why outright calls or puts often look very costly to own. Sooner or later, you will find out the vast number of option strategies available that can be created by combining bought and sold options in different ratios. By far, the simplest of them all is a call spread. You are cheapening your long exposure by selling a further out-of-the-money call. By buying a call spread instead of an outright call on its own, you are not paying that much in theta, and you can play with the magnitude of the move you expect and forgo any profit above a point you think fit. But don't get fooled. Although it is relatively one of the simplest strategies, it still has its troubles that you might not be aware of. A call spread is usually best done when the volatility curve is steep, meaning that you are paying less in IV for the call you are buying and selling the more expensive IV on the second leg that is farther out. This type of curve is usually present in spot-up, vol-up assets like gold, but can also be found sometimes in equity markets, examples being after a sell-off when it's expected to reverse. At all-time highs when investors are replacing their Delta One instruments with calls to sort of hedge against pullbacks, or when fear of missing out kicks in. While it is generally true that spreads do make sense with this type of volatility curve present, the first problem is that such a curve implies the overall level of volatility rising with asset prices going up. In a call spread, if it goes in your favor and the first leg ends up in the money, you are at that point net short volatility, as you want all of the time to decay from the second leg. Rising volatility flattens your payoff curve and lowers your profit in relation to the profit you would be having at expiration. So, if the underlying price rises with an overall rise in volatility accompanying it, your payoff at that point is a lot smaller than you might have expected. This puts you in a tricky position. Do you close the trade with less of a gain than wished for, or do you want to wait it out, risking the heightened volatility hurting your delta gains and going against you? Unfortunately, there is no easy answer to this, and you will have to create your own opinions, which will be dependent on the situation itself. Now, if the underlying shoots up and both legs end up in the money, and volatility rises once again, your sold call might not be Delta 1 yet, meaning it will still be worth more than its intrinsic value, which means once again you will have to wait it out for theta decay to do its job, opening yourself up for a possibility of a reversal until expiration. A call spread can reach its maximum payoff at some point, even with time left to expiry. That point happens when both the long and short option reach a delta of 1, meaning they are both so far in the money that they do not have any extrinsic value left, and they behave like an outright stock. This point depends on the volatility of the underlying, and if the volatility rises after trade initiation, that point will rise with it. Waiting it out is tricky since the closer you get to expiration, your payoff will get more linear and dependent on the exact price the underlying ends up at. The heightened volatility is in most cases justified with greater movement of the stock, meaning the risk of waiting it out is probably higher. Here is where you will have to make the decision if the time left in the sold option is more than what you think the underlying can move below your shorted strike. Meaning, if the underlying is at 205 and your short call at 200 still has $5 of time in it, your current break-even at expiration is at 195. This means that if the underlying closes at 195, you will lose the $5 up to 200 that you had previously, but you will gain the extra $5 time from the 200 strike. Anything below that, you are losing $1 for every 1-point move in the underlying. You usually want to sell options at a price level you expect the underlying to be at on expiration, as you can get the most out of them. You are picking the closest strike that you think the underlying will reach at expiration, since the closer you go, the more you will get for it. When applying this to the call spread, you will always have the problem of holding to expiration, as the Delta 1 behavior of the spread near the end will have a great impact on your P&L. You will often find call or put spreads look incredibly cheap. As with everything, when something looks like a great bargain, you should ask yourself if it is cheap for a reason. Spreads are actually cheap only when the market misprices the shape of the distribution, not just its direction. Most of the time, spreads look cheap because they strip out tail outcomes, the very scenarios that make options expensive. A spread isolates a narrow range of prices and sells extreme convexity back to the market, which is usually priced efficiently. They become genuinely cheap only when the market is overpaying for tails that are unlikely to be deliverable or usable, while underpaying for more probable mid-range outcomes. VX call spreads are the clearest example of this illusion. They look extraordinarily cheap because VX spikes are violent. The convexity exists on paper, but it is extremely hard to monetize. Spikes mean revert quickly, and by expiration, volatility has usually collapsed. The market therefore discounts these payoffs heavily, not because spikes don't happen, but because persistent elevated volatility is rare and difficult to capture. Traders remember VIX printing 60 intraday, market's price, how often it settles there, and how reliably profits can be extracted. What looks like an asymmetric opportunity is usually just convexity that disappears before it can be turned into P and L.